Hi, and welcome everyone to another BCNL webinar. Today, we're very excited to have Michael van der Poppen. He's also known as Crypto Michael, a full-time trader and CEO of Sanka. He will manage you through the process of how to deal with your money in this crisis. We have some important notes beforehand. Please ask your questions in the chat. You can find it in the left down corner. And you can also raise your hand if you have a specific question, but we really recommend to use the chat. Michael, may I ask you to do a longer introduction about yourself and then share your screen?
Yes, my introduction is actually in my PowerPoint, so I can just do it there, I guess.
Yeah, for sure. Let me transit.
Thank you. Let's share. Everybody can see my screen now, I guess.
Yes.
Okay, wonderful. Well, yes. Well, thank you, Rudolf and the Blockchain Netherlands for having me one more time. The last time we did it at Crypto Hopper and was about TA. And we felt like we're doing it a little bit different this time, as I'm getting this question a ton of times in the past month, which is how to safely manage your portfolio in times of a crisis. And that's going to be the topic of this webinar. But first, a little introduction. The webcam has gone away, I guess, or no? Yeah. Okay, let's put it on. Yes, nice. The introduction, I'm a student economics at the University of Amsterdam. I still have to do one more resit. Based on that, I'm interested in markets and sentiments and how the waves evolve. I've started trading crypto in the beginning of 2017 because everyone was doing it by then, and the altcoin season was great and everybody saw big numbers coming ahead. So I started to get interested in crypto fairly late, which was February 2017. Along the way, I started to trade full-time already later that year, and since then I've become a trader from Beursplein 5, which is the Amsterdam Stock Exchange, as you can see. And I'm a coach in TA and trading since the beginning of 2018. I'm writing articles on Cointelegraph as well since the summer of last year, and I've got my own YouTube channel where I share my daily videos since the past 7 weeks. And I've got my Twitter where everybody knows me under the name Crypto Michael. I'm going to change that as it's not really professional, but it's still a funny nickname. Before we're going further, I want to say that everything that I'm saying is not financial advice, and you just should consider it my own vision. Have to say it, otherwise something might be illegal. The question of this webinar is how to safely manage your portfolio in times of crisis like the current one, which is the coronavirus. A little bit theoretical before we continue is don't think too light about the coronavirus. The first wave has just gone away and we are just stabilizing a little bit during the summer while there's still an opportunity or a chance that we're getting the second or third wave. While people are saying it's already over. Well, if you go to Brazil or other countries, they are experiencing the first wave right now, so it's not gone and will most likely come back or stay underneath us. So it's still a huge problem, and the economic impact from that will come later on, as it always will. It takes some time. We are seeing some numbers going high already, which is the unemployment rate today. Another 3 million people in the United States became unemployed, which is raising the number to 36 million, which is about 20% already, not 15. I've made this presentation a little earlier, but it's 20% of the people already, which shows the significance of this crisis. So that's why the questions are raised, and that's why we are doing this. The current status of our markets is actually the return to normal period. As you can see here, probably you can see my mouse as well. We've just witnessed a very nice rally up, whilst the past few years have been wonderful. And now we are seeing the return to normal, which could be a large trap before we are going back to reality. Everyone loves debt, which means that literally everyone around me is filled with debt. I know many people from my age, I'm 27, who are buying their first house right now, and they are doing it the maximum they can do. They also have a student loan. I actually heard on the news yesterday that the people are getting more loans out while they are not working. So everybody is filled with debt, while the unemployment rate is reaching levels we have not seen before. It's even larger than the Great Depression. And the equity markets are going up. And why is that? That's what we're going to discuss. First, before we are going to go further and through all these asset classes, I want to state them. If you want to use your money properly in a good way, you have to diversify, as exposing yourself to one market. Let's say you are filled with oil. Well, you are bankrupt almost right now. So if you want to build a nice portfolio, you should have a different risk diversification, in which these asset classes are the 5 you should have, which are the equity markets, equities, real estate, commodities, crypto, and cash, which is also the approach from Willem Middelkoop. He says it, 25% in everything, in which crypto is 5% of cash. We'll get to every asset class, and we will start with the equity markets. And I will say why I don't have any of these. First, a little chart, which is Amazon. Last time I did the presentation at the Blockchain Netherlands and the Crypto Hopper, I shared this one as well. On the left, you can see the .com bubble, which was back then a big thing. And now we can see where Amazon is heading. Everybody is still interested in buying this stock, while it's actually just going absolutely mayhem, and reminds me a lot of the chart we have seen of Bitcoin in 2017, which showed that there was a nice pop in 2014, which was the previous bubble, and now we have witnessed one in 2017 after the markets crashed. I'm not saying it will crash for Amazon, but it's most likely that it's going south rather than north. And yes, Amazon is a great company. It has a great fundamental perspective. It's doing great with revenue. However, is it sustainable? And then we have to look at some numbers of the equities and of the markets, which says that the price to book ratio, for instance, for Amazon, as you can see in this table, is currently 18. This means that the current price of Amazon, or the market cap, is 1,170 billion, is 18 times higher than the intrinsic value of Amazon. The PE ratio is actually 112. All these numbers are an indication that it's far overvalued, and the value is based on possible future revenue. Well, it's not going to be that large as what we are valuing it now. The same goes for Apple, which is 17. While they are decreasing the amount of production on iPhone, they are delaying the new iPhone. The factories are remaining silent right now, or it's lower. So it's just a big fairy tale and just speculation on the price, which has to come back to reality. And if you go towards the indices, you can do the exact same thing. The current PB ratio for the Nasdaq, as this table is showing, is 6.27, which means that the complete index of the Nasdaq is valued 6.27 times higher than the intrinsic value. And why is this significant? We'll get to what the history stated. We can also see that the Dow Jones is at 3.60, the DAX is at 1.27, which states that the main problem of our current economy is based in the United States and mainly in tech companies. Tech companies are the only ones holding up the stock markets. If you get a chart with the S&P and the Nasdaq right now, without the tech stocks, it will be down already 40%. It will remain there. So the only companies holding up the whole equity markets are the tech stocks. So it could be a tech bubble 2.0. If we go towards the history, we can see that in 2007, the PB ratio for the Nasdaq was 2.76. In 2006, it was actually 4 plus. And in 2009, it came back to 0.95. And that's an interesting fact. If something is valued beneath the actual book value, so beneath 1, while the fundamentals are still fine, which you can compare it with Bitcoin at 3K during December 2018, that's a good moment you want to step into the markets. But when something is valued far exceeding the realistic value and intrinsic value, which is the case right now with the Nasdaq as it's 6.36, you rather want to get out. And if you check the chart on the right, you can see that the Dow Jones, it's a chart of the past 100 years on the Dow Jones. The big crash in 1929, the Dow Jones was valued 3.41, and the years after on the bottom it was 0.79. The same we can see in 2000, which was 8.16, and then we came all the way down, and the Dow Jones relatively stabilized after that, in which you can't really see the credit bubble and the credit crisis of 2008, but knowing what the number is of the Nasdaq right now, it's almost the same as 2000, far exceeding reality. And then the second part I want to discuss about history is that we've just said that everything is going back to normal because everybody's going back to work, everybody's starting up right now, and we've witnessed already a 40% crash on the equity markets. We've seen that in history. We've seen it in 2000, we've seen it in 2008, we've seen it with Bitcoin with the first crash. It crashed to 11.6K, came back up to 16.7K. We've also seen it in 1929, a flash crash of 50%. After that, a relative calm period of 6 months where everybody expects it to go back to normal, and then reality kicks in and the market starts to crash further down. This seems to be the case right now as well. Majority of retail traders wanted to get an account for stocks recently, which meant that, for instance, the Dutch brokers, they couldn't even get all the new customers in as there were so many of them, which means that it's the same as the altcoin period in January 2018, the last part of the bubble before everything just crashes down. It's pure speculation of people who don't know what they are doing. And if you go back to the history, people were saying, okay, equity markets are a good investment as they are always going up. Well, they are not. Experience tells everything. People saying that the markets will go up is because they've only experienced that way. In the long term, it will only go up until it changes. And that same approach is there for the real estate markets, the second group we are getting to. In the past 60 years, the prices have been going up because the rates were going down. But how are houses really valued? Is it because of demand and supply? No, it's because of the last transaction. So for instance, if I'm living at my parents right now to take care of them, if there's a group of houses here of 20 houses, and one of them, and the valuation of them is 300K, and one of them gets sold for 400K because a complete idiot buys it, the other 19 will say that the valuation of that house is also 400K because of the other house that's being sold, which is identical, is sold for 400K. That's what's going on the past years. The interest rates are fairly low, which means that people can continue buying. Housing prices were going up. Well, it's not really the value of the house. When people are losing their jobs, like we're seeing right now, they are not able to buy these houses. So it's only value on paper. If everybody starts to sell their house, they won't be able to pay that amount of money for your house. So thinking that your house is currently 400K in the example is bollocks. It's just a complete idiot valuation, but that's the reality. The demand has been gone away. People are losing their jobs. They just simply don't have money to afford a new house. They are postponing a new car. As you can see in the example here, Volkswagen Group sales were down 38% on 1 month. Which says that everybody is just postponing all the costs they have to make. So, for instance, a new car or a new house or whatever. So the supply pressure on the markets will push the price down. There are still people who are expats or whatever, and they have to sell their house, or people who are renting them out and have to get them. The supply pressure will push the prices down as everybody wants to sell their house at some point. Also, another thing we're going to see here is that people are working from home more. They are enjoying it. We've heard that around 60% of the people want to stay working at home. So we might even not need cars, which puts the prices down as well, as the companies are still producing at normal level. We've witnessed oil going in negative as there's far exceeding supply while there's just no demand. So it will all push the prices down and come back to reality after such a long period. Simple economics. More supply than demand, prices start to drop until the demand starts to pick up, until the prices are back to reality and people have the interest to start buying again, which goes to deflationary markets. And this price drop can take years. If we go back to the history, From 1929 to 1936, we've seen a deflation period for 7 years. And what are these people just then going to do if they sell their house for 400k while their house is valued at like 250 to 300k in the best scenario? They have got a mortgage for 400k while their prices are, well, the house value is dropping down, and the interest rates in the end will go up. So that will create social unrest, especially when the income is decreasing of these people itself. If we go towards the football market right now, people are giving back their salaries because otherwise the club will go bankrupt. And it's something we are going to see more in the future when the demand still not comes, when there's still no demand. Income and loan and salaries will decrease to cut costs. People will lose their job. So what will happen if you have this mortgage and you can't even afford it and the interest rate will go up? Social unrest will start to exceed if people will refuse to pay their mortgage. So people just say, okay, no, I don't buy it anymore. And then the deflation goes on, and there's more social and political unrest in the markets. So based on that, I have no interest in real estate and in equity markets. My parents, they have had some discussion in the recent months to change their mortgage. Well, we can see here that what I've just told about the experience people have, my parents have witnessed a period in which the interest rate was just going down, the mortgage rate was just going down. So they tell me that's a good idea to do so. But if you can see it in the chart, the rates have been going down for 70 years. And at some point it will change. And we're getting quite close to that. We can also see that the 10-year treasury yield has become the lowest in 230 years. It has never been lower than this. It's a big signal. And it's coming from the yield on the government bonds. They are going down even more recently. Why is that? Is that because the economy is doing so well? No, it's not. It's because there is one big buyer in the markets. For the United States, it is the Fed. For the European part, it is the ECB. They're just continuing to buy all these government bonds as it's QE, infinite QE. We're printing an infinite amount of money no matter what. We're going to save. We're going to save you. And if you see this chart, you can see that what we've just seen with the mortgage interest rates, they have seen a nice push up. It's the same for the government bonds and the rates on them. They're on their lowest point since the peak in 1980. And they have been going down even through the previous crisis of 2000 and 2008. So at some point, the ECB and the Fed will start to realize that what they are doing with buying up all these government bonds and even ETFs in the near future, that it won't help. It won't help small businesses, as the money is just not getting there. It's only there to bail out big companies and stay stuck in the banking system. With small companies and the backbone of our economy, they won't be helped by this. So at some point, they will stop. And once they stop, the rates will go up. And they have to. Given the low rates, everything has gone crazy and everything has gone through the roof, as I've just told. I hear somebody else. I don't know what's happening. Okay, I'll just continue then.
Yeah, please continue.
Okay. The housing prices have been going through the roof. However, your income has not. As you can see here, the Amsterdam valuation of the real estate has gone through the roof, as it was 22 billion in 1997. And it's currently 138 billion. On the other hand, working wages mid-class has only increased with 12% in the past 40 years. This was a tweet from 2 days ago. So while the real estate has increased by 500% or more, the working wages did not have that. So that's probably something you realize right now, is that everything is just becoming more expensive while you're not having more money to spend. The rich became richer. So what's next if I'm not holding real estate or holding equity markets is that we've got the triple C structure, which is commodities, which is crypto, which is cash. A big portion of my portfolio is inside commodities, which is gold, silver, and platinum. And because of that, we have to check some charts, as I'm always doing. What we can see here is data, and it shows the gold to S&P ratio which is the lowest since Bretton Woods 1971. Bretton Woods 1971 is a significant moment as there the golden standard was relieved, and after that the gold price started to rocket up. The second lowest point here is the dot-com bubble, the actual peak of the stock markets in 1999, after which the stock markets crashed and gold had a pretty decent period. The high here is the previous all-time high for gold. And what this chart is showing right now is that the valuation of gold is extremely low, even lower than during the Bretton Woods in 1971, which states that it's not a pretty bad moment to consider gold as a hedge for our current economy. And, then we go towards the next one, which is silver, which is called the commodity for the poor. Markets tend to go in waves. So what we've just seen with gold is that it's going towards the lowest point in 60 years. Silver has also got waves, in which you can see the ratios over here. And it's a similar chart as what we have seen just in the previous slide. It's back to the low. It's actually the lowest silver gold ratio right now since I can actually see the chart. While the highest point here was the peak of silver on $50 during 2011, and right now it's on the lowest. So if you want to consider commodities, gold is relatively low towards the S&P and silver is valued extremely low towards gold. My biggest position is in silver because of all this data. But there's also a tricky part in commodities. They are called the safe hedge, while they are not always a safe hedge, as it's just a fairy tale. And we have witnessed a flash crash on March 12th, in which Bitcoin dropped 50%. We've seen it go down from $8K to $3,700, while gold also crashed from 1,680 towards 1,400, something like it, and silver also crashed 50%. Why is that? Because in moments of complete panic and a complete crash, all the assets tend to correlate towards or get the correlation closer to 1. And we have seen that in March, the equity markets dropped 40%, and at the last part, commodities and crypto also dropped heavily. After that, they'll just go back towards the normal standard, in which we have seen gold getting new highs recently, silver lagging behind because of also the silver gold ratio, and everybody's still watching gold first, and Bitcoin getting back up to the 10K level it was before. So if we experience a further drop down in the next year, which I'm expecting to see on the equity markets, I'm remaining relatively big in cash to get myself into a position that I'm able to accumulate more of the commodities. As gold has been dropping 35% in 2008 as well. I've just explained this without showing the actual slide. So history repeats itself, and it's hard for us to understand that it could be a scenario in which we go back towards the 1930s, as nobody has experienced it. So it's a new case in which we have to realize ourselves that also the coronavirus is putting us in a crisis which we have not experienced before. So because of the big reset coming up, and because of the insane amount of debt and the high value market value of the equity markets, people probably start to lose their faith in the fiat currencies. And even if there is deflation, precious metals, and I expect crypto should be the ones that's going to rally. Even in deflation periods, people start to lose their faith in the fiat currencies, so they step over to assets that are relatively stable as a hedge, which are precious metals and crypto. So that could be the decoupling. It could also be a scenario that we're actually going up if the equity markets drop down. That's a less likely scenario, but after that we are going to see some serious momentum, I believe. So then we get towards the final part, which is crypto. I do have a significant portion in crypto, as you might understand, as my name is Crypto Miguel. We have just seen the halving, which was actually my first one. And just one block before it occurred, we saw a text here which stated, with 2.3 trillion injection, Fed's plan far exceeded 2008 rescue. It gives us a slight point to where it's going, which is the exact opposite of the Fed. Bitcoin is decreasing the supply, while the Fed is actually just increasing the infinite QE and just increasing the money supply on the markets, which can only suit Bitcoin. You should also realize that if Bitcoin goes to 500k, it doesn't really mean that you can buy more with it, as the dollar value could have been going down. So finally, we get towards the part where I'm allocating my portfolio for crypto, and then towards the whole conclusion of this webinar. The majority of my portfolio is in Bitcoin, which is more than 75%. The reason for that is that if Bitcoin doesn't succeed, 99% of the other coins are not succeeding. Bitcoin is a first runner. We are just witnessing it right now, in which Bitcoin is the first one to rally towards the halving. Probably the altcoins will follow. We've seen it in 2017. So if Bitcoin doesn't exceed, I don't see a point in that 99% of the other cryptos will do. Also, as an investor and a long-term portfolio, you should be risk averse, in which you should understand that having crypto is already a significant risk. And if you expose yourself 100% to one altcoin, you are just gambling. So I'm just de-risking myself, in which I am mostly in Bitcoin. And the other part is significantly in the majors, which are building platforms, for instance, Ethereum or the Oracle platform, Chainlink. So what I just said is putting everything in one altcoin is actually the same as going to the roulette table, putting everything on one number. I do know people who are doing it, and fine for them, but I wouldn't do that if I want to build my long-term portfolio with different asset classes. I do have some small caps, but they are just having 1 or 2% of my crypto portfolio, which is even less than 0.3% of my total portfolio. So my current allocation is that I'm in crypto for 25%, I'm in commodities for 30%, and cash 45%, which is the long-term portfolio, which is 80 to 85% of my total portfolio. And the rest I trade with, as I want to accumulate more bags, and I have to pay my costs, which are relatively low if you live with your parents, but I still have to pay them. Conclusion of this whole webinar is that the real return of your portfolio won't be made through trading. It will be made through making your own decisions and understanding how a market works. And I hope this small webinar has given a slight view into the current markets. Vielen Dank.
Michael, thanks
Yes.
so much. Great insights, I think, and it's very insightful to see your views and how you deal with the situation. Quite some questions came up. I want to ask everyone to ask their questions in the chat. Michael, can you open the chat box yourself?
Yes, I see some questions here.
So what I would recommend is that as more questions will be coming in, you can decide which ones you want to answer.
Let's see. Pascal is asking here, but what about the acceleration of digitalization in various industries? Do more people buy via Amazon? Doesn't this drive up sales? Yeah. Difficult question. I mean, everything is just going digital more, which is great. So in the end, it's going to be used more. Sorry, but a value of a company is different than the actual usage of the company itself. So for instance, if you value Amazon on 18 times the intrinsic value while the sales are going down, but some other assets like Amazon Prime or whatever is going up, that's different. The valuation is different than the actual uses of the company. So we can still be building further. We've seen it with Bitcoin and crypto. We have valued Bitcoin at 20k in 2017, but we have valued it at 3k in end of 2018. Well, fundamentally, we were just building further. So the valuation of the company is different than actually the progress on the fundamental part. So you should consider that these two things are different from each other. And what I said is, if something is valued below 1 and fundamentally right, it's a great opportunity. So in the end, if it's valued low because of a systemic crash or whatever, and the sales are still okay, you know what you have to do. Do you expect a return to gold-backed currencies or central bank digital currencies, and will that be via a period of hyperinflation? Well, A hyperinflation could be possible for a country like the States, because we already see hyperinflation in countries like Zimbabwe or in South America, and it's likely that it's going to occur on other currencies which are relatively small, as people are hoping towards the dollar. But at some point, the dollar will have inflation as well, and they will probably step in through the Fed, in which they decrease the inflation, and then the inevitable will happen, which is deflation. And that's an even bigger problem if you have an insane amount of debt. Are we going back to a gold-backed currency? Well, the only way you can actually solve this is by getting rid of debt and devaluing your own currency through another asset, which is gold. So most likely at some point we will, or we will use Bitcoin, which I don't really see happening. It's a hedge. It's not something that's been around for a long time, and still small groups can actually manipulate the market. So if going back to a gold-backed currency is likely, or maybe get a new currency, which they are already proposing, which is the SDR or another digital currency. But if we want to solve this problem, it should be by getting back to the golden standard, yes. Do you think shorting the market in the moment is a good investment, or too much risk or speculation? Well, I'm not a big fan of shorting, but if I want to get into the markets of the equities, I want to short unless there is an increasing level of inflation. And if the inflation starts to crawl up even more, you could see the actual stock markets get into levels you've not seen before. An example is Zimbabwe. The stock markets over there were just skyrocketing, but the inflation. So, for instance, if your market goes up with 60%, but your inflation is going up with 100%, you're still losing money. So if it starts to skyrocket because of inflation, then I wouldn't touch it. And if it's going to drop down because of deflation, I want to short it, but I don't want to have a big position in shorts. I just remain relatively calm with it. And if you want to short, you really have to know what you're doing. What do you think the impact will be as the German regulatory legal department has challenged the ECB buyings of debt of EU countries as being illegal? It's big. It has been discussed, but they have already answered that it's European law against national law, so they don't really have to do anything with it. But it's a question that's being raised more and more. Earlier today, I saw it on the TV as well. It's also a question that's coming up by the people itself, is whether why are they paying tax if they can have infinite QE? And that answer will come at some point, which means that they just can't keep doing what they're doing, because it just doesn't make sense. So at some point they should be stopping the printing, and then the reality kicks in. So yeah, they have challenged the ECB, but they don't really have to listen to the ECB unless the whole EU breaks apart, which could happen in the future. We don't know. It's a difficult question. How much Bitcoin do you have? I don't answer that. Don't you think that having cash stored at a bank is also risky? Or when you say having cash means you have it cold stored in a safe? Well, to be honest, I do have cash stored, as when deflation starts to occur, the banks will be the first ones to fall apart. So the governments will try to save and bail out the majority of the companies, but at some point they just can't, which we're already seeing in the Netherlands, which you will see in the States as well. Whole groups of companies going towards the government for help, and they are just not giving it because they just can't. So the banks will be taking the biggest chunk of debt, and they will just fall. So I would not have more than... It's also, if they want to erase debt, they are going to erase your bank account as well, in what you have been building up, unless you have less than 25k. Everything above that is just ready to get. Either way, you're bankrupt and you won't get it back, or they erase it because they have to erase debt as well. So splitting it between banks and having cash yourself is probably a pretty decent structure. Great presentation. Can you please tell us how too big silver or gold? Yeah, I've seen that it's almost sold out at every store. Search or just buy some ETFs if you don't have any time. That's also possible, but it's not your key, so not your silver. Could you send this presentation? Yes, it will be posted on YouTube, and actually Rudolf will also post it or upload it. Why do you think the interest rates will go up? Well, if the economic uncertainty starts to come around, so for instance, I want to buy government bonds and everything is great, then the interest rates will go down because the economy is doing fine. But at some point, when the economy is not, and the overall debt of the government is raising up, you want to get a higher premium for your government bond because you're insecure whether you're getting paid for the government bond for the next years. So during this uncertainty, you should expect the rates to go up, which is just an economic wave. Which means that the Fed and the ECB are just buying the government bonds all the time. They're the only buyers. And when that stops and they realize that it won't be helping, which Powell already smallly said yesterday, that's the point where the rates will start to go up. And that's also the point where the mortgage rates start to go up. And that's the point where the housing price will start to drop heavily. What if JP Morgan does not pump the silver market? Do you still believe in silver? Yes, I don't really care what JP Morgan is doing. They have been saying that they are not interested in Bitcoin, and now all of a sudden they are. I don't listen to any what they are saying. They always have something to say with what they are saying, and it's also their own greed. So I just do whatever I want. Should I buy and hold BTC ETH link for the long term? Well, I've just said that I want to have crypto, but it's an extremely high risk. So mainly Bitcoin, and the rest is due for probably. There's going to be one big winner next to BTC, and then some smaller companies as well. So holding some won't be bad. Is Kraken Exchange safe to keep money on it to buy quickly in case of a big BTC crash? I don't know. What I would do is just store your Bitcoin and crypto in offline wallets, not your keys, not your coins. So I would do it that way rather than having them stored on an exchange. It's the same for the money you have stored on an exchange or on a broker. It's not your money until it is in your hands. Why do you think that investing in real estate is not good for the long term? Don't you think investing in real estate is a great strategy to create passive income? Yes, it's a great strategy to create passive income until people are not able to pay the rent. And if you buy something right now, I understand if you want to get a house for like a mortgage rate of 2% for the next 30 years, you're fine. But if it's dropping, let's say you have a house of 300k and the price drops to 250k, but the mortgage rate goes from 2 to 3%. You are 30 years further, and then you've finally managed to get that 50k balance back into your bank account. So if the whole economy collapses and we have an employment rate of 30-40%, nobody is able to pay your rent the level you want it to be paid. It's going to be the level it should be, which is 50% lower. So you have to realize that the past 60-70 years will probably won't be the same for the next 30-40 years because of one moment that it's going to change, and that we're really getting close to that. What do you think about XRP longer term? It's fantastic. Best coin ever. I hate it, man. I don't know. I hate it. So I guess that's all the questions, Rudolf, so far.
Yeah, thanks. There were quite a lot. What do you think?
One.
Was it of the level that you expected?
It's the first time that I'm doing a different presentation, so it's I was quite nervous actually.
Well, no, you really got some questions coming, and I think that's a good thing. You have some quite bold statements, and that gives different views on topics. So if anyone is interested after this webinar to ask a question, you can either email team@bcnl.foundation or just follow Crypto Michael at CryptoMichNL. So that's CryptoMichNL.
Yes.
Like most of us probably already do. So Michael, thanks so much. you're always a great speaker. So thanks again for sharing this with us, and hope to see you soon.
Thanks for having me, mate.
Have a good evening, everyone.
See ya.
Bye-bye.